Although I have previously spoken about the CAEP ratio, otherwise known as the PE10 ratio or the Shiller PE ratio, it is a cyclically adjusted price to earnings ratio. You can view and listen to my previous comments by following this link right here. Today, I want to talk about some criticisms associated with this ratio. Now, one criticism is that it goes through times where it is persistently below average or persistently above average. So in this chart here, you can see that pre-internet bubble, the CAEP ratio was persistently below average, and post internet bubble, excluding the financial crisis, of course, the CAEP ratio has been persistently above average. This does not seem to properly reflect the economy or the underlying fundamentals of the stock market. Now, another criticism is that the way we account for earnings has changed materially over time. For example, FASB introduced a rule where certain marketable securities have to be marked to market. That has led to a dramatic increase in volatility of earnings. Here in this chart, you can see that during the financial crisis, the decline in earnings was dramatic. In fact, it was more dramatic than it was during the Great Depression, which was arguably much more severe. So this isn't properly reflecting the underlying fundamentals, and it makes comparisons across time very difficult. Now, another criticism, which is somewhat related, is that boom times and bust times are disproportionately having a large impact on this ratio. These are large events, and they remain in the ratio by the nature of its construction, by the nature that we're looking at 10-year averages. They remain a part of this ratio for long periods of time. It takes a long time to kind of roll off that information. Consequently, also because the bust times appear to be much worse than the boom times, it has a recessionary bias built into it because these bust times have a bigger impact, and they're in there for a longer period of time. Now, another criticism, of course, is we're looking back, right? We're looking at the last 10 years, has nothing to do with the future. There's nothing at all in that ratio that talks about the future. So it's kind of unidirectional and maybe looking in the wrong way. Now, yet another criticism is that the makeup of the economy, the market, the companies in it, how we, produce things has changed dramatically over time. So again, it makes comparisons across time very difficult. Finally, I'm going to say and reiterate that there are problems associated with any kind of PE ratio, whether it's a PE ratio or a traditional one. These get distorted, especially as they get bigger and bigger. You can see during the internet bubble, this kind of nonlinear distortion by looking at the chart. You can see a series of videos talking about problems with PE ratios here. Highly recommend you check those out. Now, next time I want to talk about some comparisons. We can look at, the US versus Europe and other regions of the world to see if these ratios across countries and regions are properly reflecting the underlying economy and market fundamentals. Thanks so much for listening.